Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. We continue to power through bull market conditions, both on a secular and cyclical basis. A global wellspring of investment opportunities continues to broaden for investors, and the technical story remains strong. For now, how will the upcoming earnings season impact the cyclical story? Will tariffs start to bite in a more meaningful way? Or will policy changes stemming from the so-called One Big Beautiful Bill kick in just in time? With the CapEx cycle for AI in relentless mode, our next guest says there is a lot to like about the current state of affairs for equity investors. Joining us now to take us through the charts that spell out a continuing bull thesis while exposing some of the cautionary elements in the marketplace is Fidelity Director of Global Macro, Jurrien Timmer, and globally available to us today from London. Nice to see you. How are your travels?
Good afternoon, Pamela. Nice to see you.
It is good afternoon to you. It's tea time, really, in England at this point. We're delighted
Yes.
to have you join us here. I wonder if we begin with the story that it just is a powerful bull market at this point. I mean, I guess there are places to go from there, but take us to what looks like pretty strong underpinnings for what we're sitting in right now.
Yeah, so we can start with slide one. It's always good to kind of take a step back because there's always so many things to worry about. And this is, of course, why we're having this show every week now for over 5 years, is to say, okay, what do the markets say? What do the facts say? What does history tell us? And so, the starting point for the conversation is we are in a cyclical bull market within a secular bull market. And that historically has been the sweet spot in terms of sort of harvesting outsized returns from the markets, right? You've got an upcycle within a long-term upcycle, and you can see here this is the MSCI All Country World Index, making new highs almost every day or every week. Got about 75% of the stocks around the world, not just in the U.S., in uptrends, and we see that red line, the global money supply is advancing. The global economy is pretty good. It's interesting, just anecdotally, I've had to make some flight changes and kind of booking flights here and there in the coming weeks, and many flights are just sold out, and the ones that are not the airfares are just astronomical right now, and so it tells me that things are okay. People are on the move. And so we have a market cycle that is now just about 3 years old. October 12th, 13th, 2022 was the start of this bull market. And even 3 years later, we're seeing earnings estimates accelerating higher after that tariff tantrum back in April. So we have, a good fundamental underpinning. We have a monetary policy regime that is now getting more accommodative, certainly around the world, but now also with the US, with the Fed lowering rates a few weeks ago. But the big conundrum, of course, is if we go to slide two, is what should we be paying for those accelerating earnings, right? So if we look at the upper part of the chart, this is a monthly chart going back to 1967. You see that uptrend line. I mean, you have to have a good reason not to be long that uptrend, right? I mean, there has to be a compelling reason to not just play the odds and say, okay, nothing compounds like equities, so that should be the anchor in the portfolio. But you look at the valuation, right? 25 times earnings, 3.2 times sales. And those are expensive levels. So it's always the difference between price and values. Price is what you pay, value is what you get. And what is the correct valuation for the markets? And if we look at that purple line in the top panel, profit margins are at an all-time high, and that counts for a lot, right? That's a bird in the hand for investors, which is why the price to sales ratio is so much higher than the price to earnings ratio, because the difference is in the margin. So that remains sort of the conundrum, at least for the very top heavy US market, with the Mag 7 now comprising 35% of the S&P 500, and sporting a 35 multiple in terms of their PE ratio, and the rest of the US market kind of gets left behind, which is why it's so good, and not to jump the gun on the conversation, but which is why it's so good that global markets are now, have now joined the party, if you will, and for very good reason, because the fundamentals globally are becoming more and more compelling.
I mean, it's that piece of it, I mean, the melt up as well, but is so different to a year ago, for instance. If you thought, okay, well, if you're looking at 35% of the US market is seven stocks, or maybe it's a little more than seven stocks these days, but where would you diversify? You wouldn't immediately think, oh, well, we'll just go global. It's quite a different year for having that as an option, I guess you'd say, to diversify into.
Yes, and as I think most of the listeners know, whether and when and how much to spread out globally has been a conversation that all of us have had for forever. I mean, it's always a part of the conversation. And for many years, really the last 10 years, it was really just academic because no matter how cheap other markets are, if they don't compete on fundamentals, meaning earnings growth and how much of those earnings are paid out back to shareholders, it's a moot point because the U.S. was just exceptional, and in many ways it still is. But if we look at slide 6, the rest of the world, especially in my view, developed markets have really become more competitive. So this is the MSCI EFA index, so non-U.S. developed stocks, and so they're trading at a 16 PE, so certainly a lot lower than the 24, 25 that the U.S. is trading at. And if you look at the bottom panel, you have the what we call the PO, the payout.
Right.
So we know what earnings growth is, but how much of those earnings are returned, if you will, to shareholders via dividends and buybacks is what constitutes the payout. And what's interesting is that the payout in EFA has grown faster over the last 5 years than the payout in the US. And the payout ratio, so the percentage of earnings returned to shareholders, is 75% for both regions. So you can really say that at least EFA, EM a little bit less, but that non-US developed stocks are truly competitive with the US, and that includes the Mag 7,
Right.
but at a fraction of the valuation. And so, we have conversations. We had one last week with one of our international PMs in Boston, and he was saying, he goes to Japan now, to Europe, and companies are becoming much more savvy in unlocking shareholder value. So regional banks that would never have considered doing a buyback are doing buybacks, and that's what is raising this payout, and that's getting the attention of investors. So for me, or for all of us, but in my view, this is really good news because if this was just the USA show, how do you diversify against a very top-heavy market with a lot of concentration risk, right? You can buy the Russell 2000, or you could try to buy an equal-weighted S&P, but it's kind of binary because if you're not in those Mag 7 and they keep running, you're left behind. So now we have non-US markets that are compelling and competitive. So to me, that becomes almost like a barbell. Like if you're globally invested, you got your US, you got your Mag 7, but you also have Europe, Japan, maybe some emerging markets. And that's nice because we want to have as big a pond to fish from as possible so that we're not just left arguing over what seven stocks are going to do. That's not a good position to be in. And so I think this is overall very good news.
It's fascinating. Can you just explain the catch up that you said over the last 5 years that EFA, in terms of their payout, has been accelerating even more than the U.S. acceleration? I mean, does that have to do with rules around buyouts? At one point, Europe was not so keen. Buybacks, I mean, sorry, buybacks. Why is that accelerated so quickly in the last 5 years?
Well, there's a couple of reasons. So earnings growth has improved as well. It starts with earnings growth, and then it's the share of those earnings that gets, paid back, if you will. And so earnings growth has caught up, and the dollar is weaker. That has a little bit to do with some of this as well. And of course, especially in Europe, the area has sort of has woken up from years of sort of just relying on the U.S. to do everything. So there's that whole kind of sense for, with NATO and Ukraine that has just woken things up, if you will. But to me, the big one is just companies are, it's been so lackluster there for so long that companies have just gotten smarter about, okay, this is just these are idle assets. Let's do something with this to be more disciplined with the capital, right? So if you think about the European banks, they're extremely well capitalized. It's just that, they're just not growing. And so it's just doing more with your balance sheet and being more clever about it and unlocking some of that dormant shareholder value. And the same thing is true in Japan. And so it's mostly that. And I think it's very good to be playing in that field. And it's interesting, in the U.S., that 75% payout ratio is two-thirds buybacks, one-third dividends. And in IFA, it's the other way around. It's
Yeah.
one-third buybacks, two-thirds dividends. But that one-third buyback is relatively new because buybacks are not really in the culture there. So that's something new, and it allows them to compete on a more level playing field, I think.
It's so fascinating how all of this works. We are heading towards an earnings season. And I guess the question around that is there anything that we think, expect, or whatever to upend what's going on right now? The earning expectations are high. They've come back from the April lows and the concerns around that. But what could, in theory, be upended through an earnings season?
Yeah, so if we go to slide 4, so we started the year, we've kind of come full circle in a way. We started the year with analysts expecting 12.5% growth in 2025. Then, of course, the tariff tantrum happened, and earnings estimates were marked down significantly, down to 7.2%. And then the tariff dog didn't bite, I guess,
Yeah.
or a little, it's bitten some, but not as much as we were expecting. And then we got the one big beautiful bill, and of course we have this whole AI boom. And so as a result, the estimates have gotten marked up again, not to where they started, but typically the numbers come down during the year. So we wouldn't really expect them to go back to 12.4. But so that's a pretty good round trip. And you can just see on that chart that it was like a blip. And, it shows the market is always in price discovery, but the market's not always right. It's just right in discounting everything that is known. And on April 2nd, what was known is different than what's known today. And tomorrow may be different again, but that's kind of how this engine works. And if we go to slide 3, this is just zooming in on the quarter. So the thick black line is the current or the quarter that will be released in a couple of weeks. So that's third quarter. And the growth rate has been very, very steady at around 7%. And you can see that's typically how it goes because the numbers come down months before the earnings season starts. But then in the weeks before, companies have generally guided whatever they're going to guide, and you get into a quiet phase. And then earnings season starts, which will happen very soon. And then almost always there is a bounce. And that bounce certainly happened the last few quarters from lower levels, but it did happen. And so if history is any guide, that 7% that is currently being expected will probably be in double digits before the earnings season's over.
That's amazing.
And maybe it'll surprise to the downside in terms of the tariffs that we can't really quantify are being felt in margins, but we're not really seeing that in many other places. So it's possible, but it's not my base case.
And
And then you have the other side of that, which is just the fiscal bill, the expensing of R&D. And, I talked to my colleagues in Boston, and the analysts are looking at pretty good earnings expectations just from our side. So my guess is it'll be a good quarter, and it'll elevate that quarter into low double digits, which is where the last two quarters were. And that puts you back into maybe a 10+% growth rate for the year. And that's good to see because the market's expensive. So we need to it needs to be backed up by earnings.
It needs to grow into those. The earnings need to grow into that a little bit.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Let's talk about actually the data that's due out this week. That this goes more to sort of the central bank story and where we head with the expectations for the economy and cuts ahead and so on. There is a government shutdown looming, and some pieces of the data actually may not come out. Do we pay attention to the shutdown this time? Is it different? This is a yearly event.
Yes, I think we've had something like 20 of them since 1970 or some number like that. The market generally doesn't care, right? So it's good to make the distinction between a government shutdown and a debt ceiling cliff, right? So if we get to a debt ceiling, you get all kinds of theatrics in Washington. But if you don't pass a debt ceiling, the U.S. would go into a technical default, right? You can't pay interest on your debt. And so that's a pretty big deal, even if it's only a technical default. With a shutdown, that doesn't happen, right? So interest payments on the debt are exempt from the shutdown, as well as other critical things like air traffic controllers and things like that. So it's the park rangers that get cut and other services, and not to make light of that, but generally speaking, when people get furloughed and then the government reopens, they get paid in arrears, and it's sort of
it evens out
all well and
eventually.
good.
Yeah.
And it is typically, again, theatrics. It's politicians scoring political points and things like that. But it just feels a little different this time because the Democrats have, and I'm not a political strategist, but the Democrats have really no reason to play nice because they have been left kind of on the sidelines, after the sweeping election last November. So they're like, no one even really talks about them anymore. So this would be a way to make a stand where their voices actually would be felt or heard, I should say. For the Republicans, the more cynical theories I hear is that this is an opportunity to actually not furlough people, but actually fire them in terms of if you're working for a government agency that the administration doesn't favor, this could be actually an excuse to take that hatchet out. And so it sounds pretty draconian, and I don't know to what degree that it's true, but it kind of feels like the stakes are a little higher this time, and that a shutdown seems much more likely now. I think the betting odds on, according to Bloomberg, are about 80% that a shutdown will happen, and so for the markets, the most immediate effect tends to be no release of economic data, as you point out. So we wouldn't get the payroll report and other reports, and is that the end of the world? Not really. The Fed just cut. It probably wouldn't cut until later this year. So it's not like a policy decision that was going to be made can't be made now. So I think the markets generally are still looking past this, but this feels like one that could kind of go down to the wire, if not beyond.
Okay, it's good to get your thoughts on that because there's a lot of discussion about it right now. In terms of the discussion of sort of cautionary elements within the markets, where do you see those? This is really comes down to valuation. Is that the cautionary tale? Otherwise, all systems go.
Yeah. So It's interesting because we've been talking about does this AI boom become a bubble? Like, is this going to end up in a melt up of sorts? And we've tracked the non-profitable growth stocks and IPOs and sentiment surveys, and the market's definitely getting more enthusiastic, let's put it that way. Kind of the junkier stocks that did very well back in 2021
Yeah.
during the meme stock craze, and then fell 70% and have been lying dormant for several years, are now waking up, right? Everyone's wondering who's the next Palantir. That's sort of the game we're in, right? And I'm sure there are companies out there promising to be that AI killer app, even though it never will happen. And so people look at, Nvidia and the other big stocks, and it's like, well, who are the next crop of winners? And actually, I was interviewed for by Bloomberg last week about that, about the Mag 7 and what's going to be the next Mag 7. And so that's certainly becoming part of the conversation.
What
And
did you tell
we
them?
have tools
What
for
is
that, right? We can look. What's that?
what did you tell them? What are the next Mag 7?
Uh, well, actually, the story's on Bloomberg today. Actually,
Oh,
it's
good.
something
Hold on.
like Mag 7 is so yesterday. Here's a new basket of AI stocks, and I just have one little quote in there. Um, but the question was more about there was a sense from the reporter that like these things like Mag 7 or FANGs are like indices that are created by people and then they create another index. And I'm like, no, that's not how it works. It's just that they're big winners. Someone is looking to put a label on them, and the Mag 7 kind of stuck, and there'll be another Mag 7 and it'll be something else, but it's not like an index committee that creates these things, right? So we have metrics for this. We have sentiment surveys. We have these baskets of stocks like the Goldman Sachs non-profitable tech. We have just a general sense of froth, put call activity. And so by most measures, this does not look like we're in the high froth stage, but I will pull up slide 9 here, which is my analog to the late 90s. And it's interesting, price analogs have flaws because they work until they don't. And obviously, no period is going to repeat exactly. So, what I've done actually with this one is, we've talked about the 90s and back when the Fed was raising rates in 2022. I constantly used the 1994 analog because that was a kind of a bear market that was created by Fed tightening. Back then, it was Alan Greenspan. There was no recession. Greenspan landed the plane. That was a soft landing. And then in 95, he gave back some of the rate hikes and the market ripped higher. And that was the start of the internet boom. And so that's on the left where the vertical line is that piece of the analog. And the market's been on that trend. And then we had in 1998, we had long-term capital. The market fell 22%, rebounded very quickly. There was no recession. And then Greenspan eased 3 times. And that created that melt up in 2000 or 1999 and 2000. So the analog kind of breaks there because the tariff tantrum was only 2+ years after the start of the bull market instead of 4 years. But you can still see that the 21% decline in April, that very fast recovery, and then a rate cut by Powell a few weeks ago, feels very 1998-ish. And then you overlay that with the AI enthusiasm, and then you had obviously the internet enthusiasm, and even headlines like Nvidia is now vendor financing OpenAI. Cisco did the same thing back then, right? It was vendor financing to create more customers for its products, and that was a sign of a little bit of a sign of froth. So my sense is, again, based on the analog, is that I don't think we're anywhere near top. But you can kind of see the roadmap a little bit. And if this market cycle does go to an extreme, and we don't know if it will, then you start wondering if that also is the final chapter of the secular trend. But again, I'm getting ahead of myself. But that could be a story for next year or the year after that.
So, and one of the things in your recent report, you take us back to the story of fiscal dominance, which is pretty much what you're pointing to with the Fed cuts and where we seem to be heading, just sort of living with more inflation. There were some comments from Stephen Mirren in the most recent FOMC meeting, or in that discussion, about why ultimately his position, he came from the Trump administration, he's now on the board for the Fed and is voting. And he was the dissenter, of course, he wanted a double cut. What did you think of his comments? He talked a little bit about R-star, which you often talk about with us.
Yeah, so it was very interesting. So let's go to slide 8. So the Fed cut 25 basis points, was widely expected. And if you look carefully at those dots, and there's many, many dots on the chart, I apologize. But the first line of dots of the dot plot, there's one little circle that's way below the cluster of the other ones, and that's Stephen Moran. I presume it's him. And he came out with a speech at the New York Economics Club, I think it was last week, and it was very interesting. And I applaud him for laying out the framework, right? Whether he actually thinks this is the right plan or he's talking his boss's book, if you will, the boss being Donald Trump, of course. But it's interesting to see the folks who are arguing for much lower rates, which is kind of what you need if you're going to run a very large set of deficits. You need some form of financial repression to help finance that. And so this is, I think, his use case, or his proposal for what the rationale would be for essentially lower rates, much lower rates than we currently see. And very cleverly, he uses a metric that cannot be observed in real time. So R star is a theoretical construct. And it used to be considered to be 2% under when it was old John Taylor who came up with the Taylor rule. Then after the financial crisis, the Fed said, okay, no, this is a moving target. It's lower than that. And they came up with the R star series that we now know. And it's about like 1.4% or so. So you add R star to inflation, you get to sort of a neutral rate, and you get into, it's around 4%, which is where the Fed is. So by the traditional R star metrics, the Fed is pretty much neutral right now, which I think is where it should be. But he's saying, no, R star is much, much lower because of a variety of reasons. And therefore, a neutral rate is closer to 2 or 2.5%. And whether you believe that or not, and I'm skeptical, it is good to at least put that out as a framework, and which then can be debated. And it's also very clever that he uses something that cannot be disputed. It can be argued, but no one can say, no, there's no way R star is there. It's here, because it's not a real rate, right? It's a theory. And so he gets points for doing that. So I think this is where the ideological divide's going to be, is like, what is neutral? Where should the Fed be relative to neutral is one argument, but what is even neutral is the other one. And so I think it's very useful in that sense that we're unpacking this now.
Yeah, it's really interesting to sort of see, as you say, at least getting some clarity on the thoughts of where perhaps the administration and Stephen Mirren would like things to go. We just have sort of a minute left or so. I wonder if you could just sort of tell us, investors, what to do with potentially a melt up. Not sure exactly what we're in here right now, but how do you go to the diversification chart and make sure you're diversified?
I think just stay diversified, and I would not want to be obviously short. Like, if you're a global investor, I could see a reason to be long non-US markets because they now have a catalyst to catch up. But at the same time, of course, if the US gets into silly season and we do have a melt up, you don't want to miss that either, because you can kind of over earn your beta, in a short period of time, provided that you can get out at the top, which is not easy to do. So I think I would just say be long beta overall. We're in a cyclical bull market within a secular bull market. Whether that beta comes from the US or outside the US, that's something we can discuss. But I would, you want to be in that 60, and then the 40 is another matter. Like closer to 4%, where the 10-year yield is, I don't think is that compelling. Closer to 5, yes, but not closer to 4. So I would just stay the course, and it's just a matter of how quickly or how slowly you earn that beta over time. And so maybe this one will come quicker, and then we'll have another conversation about what to do next.
It's wonderful to see you, and thank you for making time for us in your travels around Europe, and we wish you very well in those travels. We'll see you soon.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.